Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Activision's earnings that they presented in November for Q3 2019. Like always, I have my buddies Bull Solo and Darth Bear helping me keep track of how the company's doing. So let's get started. All the information I've collected either comes from ATVI's investors website, seekingalpha.com, or marketwatch.com. So if you guys want to find any information there, feel free to use any of those websites. First, let's start off with a quick stock returns. In the past 5 days, Activision has returned negative 3%. In the past month, negative 5%. In the past 3 months, it's up 15.8%. Year to date, it's up 13.16%. And in the past year, it's down 1.61%. Right now, the stock price is sitting somewhere around $52.70. All right, so let's get started with the first thing, revenue. So revenue was reported November 7th, 2019. Q3 non-GAAP earnings per share of 32 cents beat by 9 cents. GAAP earnings per share of 26 cents beat by 20 cents. Net bookings of $1.21 billion beat by 50 million. So we can see earnings per share beat, revenue beat. So the first point obviously has to go to Bull Solo. All right, guys, so next we're going to take a look at net bookings. For those that don't know, net bookings are all the sales done only on this quarter. It doesn't count any past backlog revenue that has just come in. It's just sales done this quarter, and it's the most truest way to see how the company is doing because we get to see what they're selling now. You see net bookings in mostly all the video game companies, Activision, EA Games, Take-Two Interactive Software, all use net bookings when representing how they're doing. And I actually agree with this concept because I want to know how the company's doing now. So first, let's start off with net bookings is down year to year. The decrease in net booking for the 3 months ended in September 30th, 2019 was primarily due to a decrease in Blizzard's net booking of $241 million. There was also a decrease in Activision's net booking of $188 million, which means the company is down about $444 million in net bookings same time this year compared to same time last year. So Q3 of 2019 to Q3 of 2018, net bookings is down $44 million. They say that the main reason net bookings is down in Blizzard is they have lower net bookings from World of Warcraft expansion and in-game content sales, primarily because last year there was an expansion release, and this year there was no expansion release. Although subscription revenue remains pretty much the same compared to a year ago because World of Warcraft Classic came out in August. So remember, World of Warcraft Classic wasn't a full game release, so they didn't collect that revenue of the game sale like they did last year. But they're saying that it was more of just a renewed subscription. But they're saying enough people came back to World of Warcraft that it shows comparable to the same time last year when the expansion came out. So that's actually a pretty good thing to know. Next, they say they are saying lower net bookings for Hearthstone, primarily due to lower net bookings from the expansion, which was released in August 2019, as compared to the expansion, which was released 2018. So we can see less people are coming into Hearthstone right now if the expansion last year did better than the expansion this year. Now, the decrease in Activision's net booking was mainly because they do not have Destiny franchise, which was reflecting in Q3 of last year. Remember, they sold that during December of 2018. So next quarter, 2 quarters from now, should be the last time they use this as an excuse. They also have lower net bookings from Call of Duty franchise along catalog titles. So we can see this quarter was the biggest decrease in net bookings. They had, like I mentioned, a total of $444 million less this quarter compared to the same time last quarter. And if we say year to date compare this year to date from now compared to the same time last quarter, it's down 748. So for that, I'm going to have to give a first point to Darth Bear here. Net bookings, right, is one of the most important things. We want to make sure that the company is doing even better than they did last time. So now let's just talk about how net revenue is doing. I just want to keep talking about how the company is distributing and how revenue is broken down in different sectors. So digital sales are down 505 million. That's 13%, and this is in the 9 months. I'm not taking a look at quarter anymore. I'm taking a look at the 9 months. So this is year to date. So digital sales is down 505 million, 13%. Retail channels is down 165 million, 22%. And you know, it's actually an other, what they call other revenue is up 54 million, and it's up 15%. But that's why I ended up putting the actual numerical value, because even though it's up 15%, it's only $54 million compared to the down 505 and the down 165 from digital and retail. And just so you guys know, other is revenue that comes from eSport, Major League Gaming, and Overwatch League. Now let's just take a look at segment revenue. So if you guys don't know, or I should have explained this earlier, Activision is pretty much made up of 3 companies or 3 sectors. The first is Blizzard, and you know, with Blizzard you have World of Warcraft, StarCraft, Hearthstone, Overwatch. Then you have Activision. The main game in Activision is Call of Duty, but they also have other games. I think Crash Bandicoot is part of it. And then they have King. King is mainly their mobile platform, which has Candy Crush. So Candy Crush is part of Activision. So we're gonna see Candy Crush is actually the biggest money maker for Blizzard, for Activision. So King makes up 152 million, $1.52 billion for the past 9 months, where Blizzard only made up 1.1 billion and Activision made up $0.8 billion. So you can see King is definitely the king of Activision, followed by Blizzard, followed by Activision, which is pretty funny, right? Activision, the main company's name, is actually the slowest driver of the company. And we can see King also has the biggest segment operating income. Operating income from King comes at 543 million, where Blizzard comes in at 204 and Activision comes in at 153. But that's not here what I'm trying to talk about. I'm trying to see the revenue. So Blizzard is down 13%, $479 million compared to the same time 9 months ago. Activision is down 15 million. Not bad. And King is pretty much flat with only down $15 million. Actually, my bad. Activision is not down 15 million. Activision is down 253 million. That 15 million was for King. So King is pretty flat while the other 2 companies are bleeding. Now let's talk about Activision's future plans. So for future plans, I'm going to have to give a point to Bull Solo right off the bat, just because I can't tell if the future plan is the smartest move to take, right? I don't know what the future holds. I don't know how the customers will hold this response. But I just know that a company needs to have a roadmap of what they need to go and how they're going to go about it. And as long as they have that, that to me is definitely great news. And this company definitely has this. They have a 4-pillar plan, which what they call, and it's pretty much to just focus and invest on their big name products. So they have, in their 4-pillar plan, they have major content release, live operation, franchise expansion to mobile, and new engagement models. So for major content release, they did the following. They released World of Warcraft Classics for their big name World of Warcraft in Q3, which added record numbers in subscription plans in Q3. Blizzard announced the next World of Warcraft expansion and the sequel to Overwatch and Diablo. Again, all big names. Then they did exceptional release with Call of Duty Modern Warfare launch in October 25th, I think it came out. So now for live operations. For live operations, their World of Warcraft Classic sustained strong engagement in Q4. They also talk about Call of Duty and how Blizzard announces new Hearthstone expansion and coming out. Next, they want to move from franchise expansion to mobile, and Call of Duty Mobile is one of the top mobile launches in history. So this past October, they released Call of Duty for a mobile platform, and in October, it significantly increased the reach for the franchise. 100+ million downloads in the first month, reaching the top of the mobile app download charts in 150 countries with a 4.9 star rating. So that's pretty impressive, right? They released Call of Duty for mobile and it was a huge success. And they also have monetization trends for the Battle Pass and first seasonal events that have been strong. So right, with these usual games, Call of Duty mobile games, with any of these mobile games, They have little small charges here and there if the player wants to buy. And with such a huge, vast majority of customers willing to play this game, the potential to $1 here, $2 here, it makes this revenue a huge success. So they're doing that. And finally, they're adding new engagement models to their franchise. And one thing they noted here is King's advertising business nearly doubled year to year in Q3. So like I mentioned, this is going to be a point of bull solo. They have a nice plan ahead of them. They know what they're trying to do. They're trying to focus on their big names. And that's how they're proceeding. Just some things to note. Some of the upcoming games in the pipeline. Like I mentioned, in this past August, they took out WoW Classic. In October, they took out Call of Duty Mobile. In October, they also took out Call of Duty Modern Warfare. In Q4, they're expecting Hearthstone expansion. In 2020, they're expecting another WoW expansion. They mentioned Overwatch 2 and Diablo 4. But with no release date. They also have, I don't know why they don't have it here, they have Warcraft 3 coming in Q4 of 2019 or Q1 of 2020. And like I said, I put the past games because these games like WoW Classic, Call of Duty Mobile, and Call of Duty Modern Warfare, even though they already came out, they just came out a few months ago. So it's still good to know that this company has had some releases in the past. In the near past. So now we're going to talk about MAU. It's like monthly active users. So monthly active users has decreased by 11 million or 3% compared to Q3 of 2019 and Q2 of 2019, primarily driven by a decrease in average monthly active users for King. So we're down 3% to last quarter, so Q2 2019. And the biggest reason is because of a decrease in monthly active users for King. So let's take a look real quick down at the bottom chart. I'm probably blocking some of it, but Activision this quarter has 36 million monthly active users. Blizzard has 33. King has 247. So that's to Q3, and that's 360 million. In the previous quarter, Q2, Activision had 37. So Activision lost 1 million. Blizzard had 32, so Blizzard gained 1 million, so that was offset. King was at 258, and that was the 11 million loss this quarter. We're now sitting at 247. But now let's take a look at the same time last year. Average monthly active users decreased by 29 million or 8% for Q3 2019 compared to Q3 2018. And the year-to-year decrease in average is due to the following. So first, they have a decrease across King's various franchise other than Candy Crush. So like I mentioned, King's is Activision's mobile platform for all these short games, and their biggest name is Candy Crush. They do say that they also have other smaller names. I actually not sure what those other names are, but those other smaller games have produced less engage. But it was partially offset by an increase in average monthly active users for Candy Crush franchise, which is understandable, right? Blizzard says they want to focus mainly on their strong platforms. So obviously there might see some decrease in the lower ones, but like Candy Crush is their main headway in King, so they're going to focus in it, and we can see there was an increase in average monthly active users. Now in Activision, it was primarily due again to the absence of Destiny. So if you guys saw my last video, I'm tired of them mentioning Destiny, but it's true. I can't wait for next quarter, for next 2 quarters where I don't have to hear this excuse anymore. They also reported lower average monthly active users from the Call of Duty franchise, which might increase next quarter with the release of Call of Duty Modern Warfare and the release of Call of Duty Mobile. Then there was a lower average monthly active users for Blizzard, primarily due to lower average monthly active users of Hearthstone and Overwatch, because they do mention that there was a huge increase of monthly active users for World of Warcraft. So World of Warcraft is actually still pretty strong. The heavy ones are, the ones lacking are Hearthstone and Overwatch. So because we do see a decrease in both quarter to quarter last year and quarter to quarter from Q3 to Q2, I'm gonna obviously have to give a point to Darth Bear on this one. Next, let's take a look at shareholder return. This company, let's just start off from the bottom for some reason. Dividends, this company gave dividends reported on February 12, 2019. that the company was going to give a 30 cents per common share. Their dividend seems to be paid only once a year, so it's not that strong. Like you can see, Activision right now has less than a 1% dividend yield. Then the company also has a repurchase program. On January 31st, 2019, the board of directors authorized repurchase program for $1.5 billion of their common stock. And this authorization is from now until February 13, 2021, or until the board of directors determines to discontinue the program. So it can actually be finished earlier. But as of September 30, 2019, they have not purchased any shares under this program. So my real question is, what are they waiting for? The company was down to about $40-something during this period. I'm not sure why they couldn't pick up some shares. And that to me is a little bit troubling. But I'm going to have to give a point to Bull Solo on the shareholder return, right? Because this company is maintaining a steady, even though it's once a year, it's still maintaining a steady dividends. And I think it has been increasing. That I think it used to be 32 cents last year. So there is an increase in dividends. I do wish they would pay it out more. And then they also have a strong repurchase program available to them. But I definitely want to see them take and start buying some shares at the moment to give investors the confidence, right? Because as an investor, you're saying this company has $1.5 billion. Why did they not buy the company share when it was at about $45? What are they waiting for? Next, we're going to talk about this company's debt. So the company has increased its cash by a healthy amount. So here, if we can take a look at this chart on top of me, this graph, cash and cash equivalents, same time a year ago was $3.43 billion. Now it's sitting at $4.95 billion. So that's about a $1.5 billion increase in cash over the past year. One thing is, it doesn't seem like this company has taken up any new debt. Same time last year, they had a $2.7 billion gross debt. And right now, they're still sitting at that $2.7 billion. So again, why have they not paid off any debt? Are they just trying to build cash at the moment? So right now, their net cash, if we take their cash investments minus their gross debt, right now is sitting at $2.25 billion of positive net cash. Where at the same time last year, this company was sitting at less than $1 billion of net cash. So that's pretty good right there. They're increasing their cash flow. They have a positive net cash flow. So this, in my opinion, this allows them to not have to take out any future loans, in the future, especially if rates start to go back up. They'll have cash ready on hand. And another thing, I do know they're not paying off their debt, but they have no long-term debt until 2021. So in 2021, they have senior notes that are due for $650 million. So this company can easily pay all its total long-term debt. And that to me is pretty impressive. But just so you guys know, 2021, $650 million, 2022, $400 million of notes. And then after that, the next one is 2026 with 850, 2027 with 400, and after that, 2047 at 400 again. So this company has no short-term important debt that we should know about. All the long-term debt is due to 2021. I'm liking that cash flow positive and that net cash flow increasing dramatically. So obviously, I'm going to have to give a point to Bull Solo on this one. So now we're going to take a look on the outlook based on the company. So the company reported, gave us a guidelines for how it's going to do. And we saw how net bookings has done year to date compared to the same time last year. So we're not seeing anything different here. They reporting that they're going to have a net revenue of about $6.3 billion at the end of this year. Where, just so you guys know, last year's total was $7.5 billion of revenue. So there is a decrease of that. They're reporting a quarter revenue of about $1.8 billion, where same time last year was $2.3 billion of revenue. So we're still seeing a decline year to date, year to year, and quarter to quarter. So for that reason, I'm gonna have to give a point to Darth Bear on this one. But don't be so worried. Let's take a look at the outlook based on analyst, one of those two. So here, earnings per share growth for 2019. So for 2019, they are estimating earnings per share to be $2.21. And let's just take a look at how the company reported. So for 2019, the company reports that there'll be $2.13. Analysts say that they're going to be $2.21. I personally think, this is my opinion here, that they're gonna definitely beat this outlook, because if you guys have not seen all my other videos, one thing that Activision gets me heated up is they go super conservative on all their future guidance. They go extremely conservative, and then they beat them, and they're like, oh, we beat them, congratulations. And that gets me so heated. Why don't you guys give me actual numbers that you guys are trying to achieve? But like I said, I'm 100% sure that they're gonna beat this. Well, I'm not 100% sure. In my opinion, I feel very confident that they are gonna beat this $2.13, and they are gonna beat the revenue that they produced here. So if they're gonna beat $2.13, I still think they're also gonna beat $2.21. Then for December 2020, they expect earnings per share to be $2.47. So we can see, right, after this year of the slowdown, this company is expected to have a strong, its growthness coming back. And like I mentioned, one of the reasons they do mention is that portion of revenue coming out from Destiny did take a hit on them, but they never really showed how much of a hit it really took. Like, I want to know, how much did Destiny make during these quarters? And that's not one information they provide, but we can see earnings per share is increasing, and we can see that forward PE ratio coming down. And still, this company with the forward PE ratio of 21.16, I think is still pretty cheap. If you took a look at my last video for Q2 of Activision was about $45 at the moment, probably lower. And I said that this company I would gladly buy under $50. I did not mean that $50 was the worst. After $50, it wasn't a time to buy anymore. But I just said anything below $50, this company is definitely worth it. But right now, sitting at low 50s. I think it's at 52 right now. I am picking up a few shares still now. I just opened up a new account. I might do a video on them. I opened up a new account when now the market is all-time high. So maybe if you guys want to see a video like that of what I'm investing now that the market is at all-time highs, and this is a brand new account, so everything I'm buying here is while the market is all-time high. So I might get burned in the process, but I think it's always important to invest your money no matter what time. It's just, you just have to be careful on how you invest. So hey, I might pull out a video on that later. But back to this. Now let's take a look at revenue. So for revenue for 2019, this company, analysts expect this to make $6.36 billion. And let's say what Activision says. Activision says they're going to make about $6.3 billion. So that's pretty much on par with this. And like I said, Activision always gives us very conservative numbers. So I think they are going to beat these numbers, and we're going to see a beat here. So Activision, and now let's take a look year to year for 2020. This company is expected to make $6.94 billion, almost $7 billion, almost to where it was at in 2018. So we can see forward PE ratio is decreasing, forward price to sales ratio is also decreasing. And for that reason, I'm gonna have to give a point to Bo Solo here, because that tells me that this company is still growing and this company can still make money. And for a company that's still growing, still making money, giving you positive shareholder returns, giving you positive cash flow, we'll take a look at it in the next episode. I still think a forward PE ratio of less than 20, around 20, even around 20, less than 25 is still pretty healthy. I personally do not mind investing in this company with a PE ratio of less than 25. So that's it, guys. I hope you guys enjoyed the episode. I'm going to do one more episode after this, seeing how the company's doing numerically wise in the 10Q report. Just see some trends going on there. So I hope you guys enjoy. Let me know what you guys think. Have a good night and see you next time.